Good morning, everyone. Today we're going to talk about loans glossary, which is the main terms and keywords we need to know in order to handle loans accounts. To be honest with you, I think there are a lot of terms I didn't know, for instance, so don't panic. And if you do, it's okay. So let's begin. Let's start with the basic terms. Debt is an amount owed to another. Principal, the total amount borrowed in a loan. Interest, it's a percentage of the amount to be repaid by the borrower in addition to the principal. Minimum payment corresponds to the minimum amount the customer must pay on a loan. It is usually monthly. Delinquency. Delinquency means that you are behind on payments. Default. Once you are delinquent for a certain period of time, your lender will declare the loan to be in default. The entire loan balance will become due at that time. Lien is the lender right to take and hold or sell the property of a debtor as a security or payment for a debt. Depreciation. It's a value of property declination. For instance, cars are susceptible from depreciation. Lender. The bank, mortgage company, or mortgage broker offering the loan. Underwriting is the process of verifying data and approving a loan. For instance, let's say I'm applying for a BBVA personal loan. So the bank goes through an underwriting process to verify my credit history, which is a record of my open and fully repaid debts. Credit history helps the lender to determine whether a potential borrower has a history of repaying debts in a timely manner. With the credit history information, a credit report is created by a credit bureau. This credit report is used by a lender in determining a loan applicant's credit worthiness. So, let's say my loan application was successful and was approved. So, the closing is going to be the date and place at which all documents for my loan are signed, date and notarized. The takedown is the actual transfer for money from a lender to a borrower under agreement. Now let's talk about non-purchase money, which is a loan in which the proceeds are used to purchase items that are not used as collateral for the loan, while purchase money is any loan secured by the good for which the proceeds are used to purchase. For instance, an auto loan. Let's review some of the terms we've talked about. Now let's continue with some loan terms that we already know, like collateral, which, well, I think we already know what it is. Curtailment, which is a payment that will only be applied towards the principal. Escrow, funds set aside and held in trust, usually for payment of taxes and insurance on real property. When taxes and insurance are due, the bank automatically makes a payment for the customer from the escrow account. Fixed rate, an interest rate which is fixed for the term of the loan, and payments are also fixed at one amount. Grace period, which is a period of time during which a loan payment may be paid after its due date, but not incur in a late penalty. Annual percentage rate, APR, it's the cost of credit on a yearly basis, expressed as a percentage. Now, let's make some questions. Let's review what we have talked about. And let's continue with some loan terms we also already know. Consumer credit, which is a loan or line of credit extended to an individual in which the proceeds are used for multiple purposes. Revolving line of credit, which is a loan that allows additional funds to be borrowed as debt is paid down, as long as the outstanding balance does not exceed a certain limit. We have the secured and the unsecured loans. These two features tells us if the customer, the borrower, was asked to put up a collateral or not for the loan. Installment loans, which are funded in one lump sum over an specified period of time. We can say equity is the difference between the value of your home minus the balance you own. So equity, it's the amount of your home you can call yours. Home equity loan, it's when you borrow against the available equity in your home, so it's secured by it. The interest paid is usually tax deductible, so these types of loans are recommended to replace or substitute for customers' loans whose interests are not tax deductible. There's also the home equity line of credit, which is a revolving account. And for this kind of loan, simple interest on this credit are often deductible. And now let's review a little bit about type of loans vocabulary. Well, now to finish, let's review some mortgage terms. A mortgage loan. It's a loan which utilizes real estate as security or collateral to provide for repayment. Mortgage is a legal document that pledges to the lender as security for payment of a debt, so it is a document. Mortgagee is the lender in a mortgage loan transaction. It is pronounced mortgagee. The mortgager. The mortgager is the borrower in a mortgage loan transaction. And the last term I'm going to explain is cash out. That is when you receive money back when refinancing your present mortgage. So that's it. I think for this last part, the exercise could be the mortgage, mortgagee, and mortgager pronunciation. I must confess those three pronunciations were really difficult to me, but maybe for you it's going to be pretty easy. So thank you very much, and I'll leave you with the Google Translate pronunciation for those three words. Pretty funny. Bye. Thank you.
Mortgage, mortgagee, mortgager.
Mortgage, mortgagee, mortgager.
Mortgage, mortgagee, mortgager.